my good friend and mortgage expert, Greg. Greg, how you doing?
Doing good, man. Good morning. Happy Saturday.
Happy Saturday morning. It's about 8:30 or 8:44. So for those of you up early today, we have a good conversation that I think will be valuable and fruitful. Today we'll be talking about how to go through a seamless pre-approval process, which is a key aspect of buying your dream home. Many of us, I have found, have many questions as to what are some of the documents to provide, um, what to do during the process, what not to do, and many other. So today, our goal is to uh, um, give you the knowledge as to what you can expect when you start going through this pre-approval process, so as to minimize any surprises or of unforeseens. So let's kick it off. And Greg, tell us, what are some of the basic guidelines most buyers will have to go through when getting pre-approved for a home loan?
Yeah, yeah, for sure. So, you said something important there. You said most buyers generally, right? Any mortgage that you apply for is going to be specific to you. That said, there are guidelines that are set by government organizations or government backed organizations, Fannie Mae, Freddie Mac, FHA. And they set these rules with the intent, at least, to protect consumers, to ensure that consumers can pay back their debt without taking on too much. And so they have these rules, and it's a mortgage company's job to, uh, if they're going to get somebody pre-approved, to make sure they're staying inside of those rules. So I've got some basics here, some slides I want to click through real quick to uh, to run you through that. So there's there's more categories in this, but generally speaking, these are going to be the ones that it's important to know. Here we go. So anytime you're getting a mortgage company is going to want to see 2 years of employment history. Now, this doesn't have to be necessarily in the same job. Depending on your circumstance, it doesn't even have to be in the same field. We just want to see that you have worked a job for at least 2 years, even if it's not 2 years concurrently. Ideally, it's in the same job. Ideally, it's in the same field. And in some instances, that will be necessary. But a very base level measure of this is that we want to see 2 years of employment history, period. And on the second line there, it says training counts. So, for example, I have a good friend of mine who graduated from medical school and was in a fellowship, which is basically another 1 year residency, and just got a new job as a physician and hadn't worked as a physician outside of his residency for 2 years. But his medical school training and his residency work count because they were training tools for his job, right? And you can apply this to any field. If you have, a year and 9 months as a mortgage loan officer, but you spent 3 months taking classes and preparing for your test, and you can document that, we can utilize that for employment history. Your credit score. Your credit score, the biggest thing about your credit score is it's gonna do two things. It's gonna indicate which program is most advantageous for us to use when we're looking at different loan programs. And it's gonna impact how much your interest rate costs, and if you're paying less than 20% down, how much your mortgage insurance costs. That's the biggest indication that your credit score is going to give us. And just as a warning, if you're going through this process, typically the credit score that a mortgage company pulls is going to be somewhere between 10 and 20 points lower than what you see on Credit Karma. We use a different FICO model that has a deeper and more robust credit history that tends to be a bit lower than Credit Karma. So if you see that, that's normal.
Well, one thing to highlight on that,
Sure.
because I just went through this recently. Not only that applies to Credit Karma, but also some of these other companies, including your bank account,
Mm-hmm.
your credit card app. All of these companies offer you the option to stay on top of your credit score. Uh, for some of them, you have to pay, others provided for free. Just know that those models, like Greg said, are not the same that a lender or bank will use for your credit score. And Greg just said that they may vary by 15, 20 points. I had someone where the delta was almost 40 points. And that's not to alarm anyone. It's just simply to say, do not rely on that number you see from these other companies to be the one a lender will use to pre-qualify you for a home loan.
Correct. Correct. And if your credit score does come in low, or and it maybe it prevents you from getting a particular interest rate, or being maybe you're a few points out for qualifying for a particular program you want. Most lending institutions have data that would suggest what you could do to increase that credit score. So for example, I get when I pull somebody's credit, I get projections on what that person could do to increase their credit. Most of the time, almost always, it's just pay down debt. So if you paid your American Express card down $600 and you got it below, 30% of your max, that's going to bring your credit score up. And so if we did this and then we rescored your credit, you'll have a score that will help qualify you for whatever. So if your score is lower than you anticipated and lower than you would like, ask your lender, hey, what can I do to get this up? And they should have some steps for you.
I don't want to spend too much time on this, but it's really important. Your credit score is super important for the reasons Greg just said. It's going to determine the cost of the loan, essentially, and eventually how much you can qualify for. In doing some research, I read that 35% of your score is your debt, recurrent debt, um, liability on a monthly basis. Is that true, Greg?
In terms of usage amount?
Yes. So, for
Yeah.
example, yeah,
Yeah, that doesn't surprise me at all. I don't have the exact number on it, but it is a huge part. And we can see like gigantic swings. So when I look at a credit report and I see that somebody's, say, for example, in the like mid to high 600s, but doesn't have any, say, like late payments or collections or what we call derogatory marks, almost always I look and see what their usage is on their revolving accounts. And to a person, they could improve their score by 50, 60, 70 points if they have the funds available to pay down these revolving accounts. Now, it's not I don't assume that people do, but if they do, you can make a huge difference with monitoring that usage. It's a gigantic part of it for sure.
yeah. All right.
For sure. Okay. So debt to income. So this is a buzzword that probably if you've been looking to get a mortgage or looking to buy a house, you've heard this. The thing that I want to emphasize here is that when a mortgage company like mine creates a debt to income ratio, what they're doing is they're determining what is the balance of your debt and your income on a monthly basis. They're not looking at a 360-month average, 30-year average. They're looking at what can you do, what can you and your family do based on the situation you're in this month. Okay, this month. And so the way we calculate mortgages is what is your ability, how much can you repay in terms of debt based on how much debt you currently have and how much income you currently make. And it's based on a monthly basis. So rough calculation. When we look at debt to income, we're going to start with your monthly income amount. This is before taxes, your gross monthly income. And for ease here, I'll just touch on this briefly. The bank is always going to take the most conservative number they can, right? So if you have a base salary, great, it's easy. If you have a set number of hours that never changes and an hourly wage, great, it's easy. If you're in a situation where you have commission, overtime, bonuses, we're going to take a 2-year average because you might have had a killer year last year because you were selling work from home products, and then after, kind of like COVID has passed, your this year has been slower. So they're going to take an average because they want to make sure that we're not, as a bank, we're not putting you in a position to not be successful, giving you qualification based on the best of the best year you ever had. So once we have that number, that monthly income number, you basically chop it in half, right? You divide it by 2. And then you subtract out your minimum monthly debt payments. So an example of that would be like if you have a Chase credit card, and let's say you use it monthly, you spend 3-4 grand on it a month, you pay it off at the end of the month. Typically, what we'll see is there'll be a minimum payment on there, $25, $40. And so that $25 or $40 is your minimum debt payment for that account, right? If you have a car loan, that would be another thing that would be subtracted out of your monthly income as a minimum debt payment. A student loan, a personal loan, etc. So we subtract out the minimum payments from that monthly income, and whatever is left over is what your principal, interest, taxes, and insurance, so your entire home payment, can be, right, up to that max. And then what we do with that number is, we zoom it out and we amortize it over 30 years, right? And once we do that, my software spits out a number that says like, hey, if your monthly payment is $2,400, your pre-approval amount is around $300,000 for a house, or whatever the number is, and it would vary from product to product. But we're not actually saying, you have the ability to repay $300,000 today. It's that, nope, month by month by month by month, this is the amount that you're allowed. So that debt to income ratio, in combination with the other things we mentioned, is I would say that debt to income and credit are the single most significant factors in home loan qualification.
Let's put some numbers on that to illustrate. So let's say that someone, and by the way, this is household income, right?
Correct.
Assuming that a couple are going in together and applying for a home loan. Assume that together they bring in $10,000 a month.
Yep.
And that is pre-tax. So according to the formula, we divide that by 2. So now we're looking at $5,000. Of the $5,000, we're going to subtract, or the lender will, student loan payments. Say that those are $500, and you have a car payment, another $500, and say credit cards, another $500. So 5,000 minus 1,500 is 3,500, and according to the guidelines, that is the amount a lender will use to pre-approve you or to determine the loan amount. So when we talk about loan amounts, in actuality, a lender is actually pre-qualifying you for a monthly payment. And based on that monthly payment and the rate that you qualify for, then that dictates or determines the actual loan amount that you qualify for.
That's right. Yep.
So on account of this, it is key that you manage your monthly debt. Unless you're making, pretty good money, what's going to help you the most is to keep your debt load as low as possible. You can make an argument that if you have, I don't know, say $20,000 worth of credit card debt, instead of using that or all of it towards a down payment for a house, you might be better off paying that credit card debt to a more reasonable balance, because it's going to improve the terms and the cost of a mortgage loan. This is not a solution for everyone, but in many cases, seems to be the more sensible approach. So you end up with the best possible terms. What are your thoughts on that, Greg?
Oh, every time. I mean, especially when somebody's like right on the edge of qualifying for the amount they want to qualify for, maybe that's just specific property. I always take a look at the liabilities and, see what would be a reasonable use of your funds. So, if somebody has kind of like a minimum down payment and they're fighting really hard just to get into a home, it may not be an option for us to pay down a bunch of debt. But if somebody says, hey, Greg, I want to put 15% down, 20% down, sometimes even 10% down, I'll take a look at their debts and say, we can do that. That's fine. But we could also pay your car off or pay off your 3 credit card bills that you've been holding a balance on for a year or whatever. That's actually going to increase your qualification amount, and potentially give you a better interest rate. Because your debt to income ratio is so much lower, it might be a much better process for us, to get you qualified this way. And the other thing is, like, if I say to somebody, hey, here's, your interest rate is X or your payment is X, and they freak out. I can't afford that. I'm not going to make it work. And I say, well, hold on. What I did in order to get you to qualify for that is I assumed that we would pay off your car loan. And they're like, oh, it's $450 a month. And I said, I know. So the extra 300 on your mortgage payment that you were freaking out about actually is saving you 150 bucks because now your car loan's paid off. And so when we talk about a full process, paying off liabilities, looking at an entire financial picture, it can be a huge, huge win to pay off liabilities. It can be a much better process for getting into a home and qualifying for the home you want. You just got to be willing to ask the question. And if your lender hasn't talked to you about it, ask them, should we pay off any debt? Is that a better use of my funds? Because really, like, your interest rate or the numbers that you get on a loan, at the end of the day, what they really do is they dictate your monthly cash outflow. And if you can control that, even if the numbers on paper on your loan are like mediocre, that's going to be the biggest thing, right? If you can improve that, if you can find a way to improve your cash out of pocket on a monthly basis, that's going to be a bottom line that really makes sense for a household. So, yeah.
Yeah, by far the biggest impact. So to be even more specific as to some of the documents you'll be asked to provide
Mhm.
right off the bat, and again with the caveat that the requirements are buyer specific. But generally speaking, if you are an employee, you can expect to be asked for the last 30 days of for pay stubs,
Mhm.
last 2 W-2s,
Mhm.
the 2 most recent bank statements. And on this one, it can be a little bit annoying uh, because a lender will want to see every single page on the bank statement.
Yep.
So if it's a 9-page file and you don't send page 6, they're going to come back and ask you for it.
Even if it's blank, even if
Even
it's
if it's
blank.
blank, there we go. The reason being is one, they want to see uh, uh, proof of income in terms of your deposit from your employment, but even more importantly, any unusual activity. So, for example, if you're getting paid $5,000 a month, and then all of a sudden they see a deposit for $15,000, they will ask you, where is that coming from?
Mhm.
Same with a large withdrawal. Hey, we see that your recurring debt is about $500 a month, but on your bank statement, we see that every month you're paying $1,500 to somebody else that is not reflected on your credit report. What is that going to? So the whole point is that they want to make sure that you can repay the loan, that you have the resources to pay back the loan. So if you have any uh, large or unusual deposits on your bank account, they want to make sure that that is not a loan, a credit line that you're pulling from somewhere to inflate your credit card statement. Or if you're having large withdrawals, same, they want to make sure that you don't have additional debt uh, on top of what's already showing on your credit history. So 2 bank statements, and if you are self-employed, last 2 tax returns, they're going to average that out to determine your qualifying income and a profit and loss statement year to date.
Mhm.
Those are table stakes um, um,
Kind of
basic guidelines that you can
baseline
expect.
documents. Yep.
Yeah. What else they can expect?
I mean, that's a pretty good list for starting. Um, Typically for me, what I do is I collect the documents needed to generate uh, what we use for a qualifying monthly income number. And then once a client gets under contract, we start to pick up more specific documents. And different lenders do this different ways. Some people send out the full list right away, and that's fine. What I have found is that for somebody who's just made the decision that they're really like that they're willing to step in and buy a house, oftentimes getting a request for 12 different documents from a lender can be incredibly overwhelming. So I try to chop it up a little bit, and I get enough for a pre-approval. And then if I need more, I ask for more. And then once they're under contract, I collect the remaining documents that we need for underwriting. Once we submit to underwriting, underwriters will ask even more specific. This is when lenders ask the questions that Alejandro was mentioning. Hey, we saw an outgoing, an outgoing $1,500 on a monthly basis coming out of your checking account. What is that? It's not shown on your application. And then you would write what's called a letter of explanation, explaining what that is. Most of the time, if it can be reasonably documented and explained, it's not going to hold up your process. But they will ask about it, because you're right. It's lenders' responsibility, as per the federal government, to make sure that borrowers can repay their loan. In addition to that, the federal government has these guidelines to prevent things like money laundering through real estate, right? Nefarious activity on a kind of a more organized crime scale. And so there are these guidelines to help eradicate that from our industry as well.
Yeah. I always tell my clients, if you have any drug money, under the mattress, check with your lender before you make that deposit.
Yeah.
And I'm kidding, but I'm not. There's a lot of people who like to just keep cash on hand,
Mhm.
and again, all of it has to be sourced. It's the term they use, since we just
Yep.
documented.
Yep.
Have to have a paper trail to it.
Yeah. I
Um,
mean, the basic standard, and this is, I'm not saying anything that's like an industry secret here. If you do have cash, or you like to keep cash on hand, but you also know that you're going to go through this process, you need to be able to show a balance with that cash in your accounts for 2 full statements before that money is seasoned. So, if you've got whatever, $5,000 in cash and you want to use it towards your mortgage process, put it in your bank account now, because you need to be able to show 2 full statements after the month of the deposit in order to use that. Otherwise, you have to be able to source all 5,000 of those dollars with a paper trail. My guess is that for most folks that have cash on hand, they don't have a paper trail for that cash. So that's the industry standards, that 2 months of seasoning.
yeah, yeah. We should probably make this video or have this conversation in Spanish, because that is almost the norm
Really?
in the Hispanic community. Because um, a lot of us, these guys are running construction companies, framing companies, and why not? And
Sure.
they keep a lot of cash on hand.
Yeah. Yeah.
Um, so brush up on your Spanish so we can replicate this
Okay.
conversation.
Yeah.
Um, this conversation might seem boring for many people, but unless you're buying cash, you're not buying a house without understanding the pre-approval process. And I run into uh, the situations in which the eagerness from buyers is just take me out and see houses like right away. I've been there, I get it. The fun part of buying a house is actually getting out there and touring homes until you find the one you love. But the thing is that is not the first step in the process. Unless you know how much you can afford, how much a lender is willing to give you, you might setting yourself up for disappointment by starting the process by looking at houses first and then handling the financing aspect second.
Right.
So we're having this conversation in an effort to help you have a positive, seamless experience when you go through the process of buying a house. Many of us assume that, I have a good job, I have good credit, I'd be good to go. And chances are you will, but it's not necessarily the case, and you might run into surprises along the road. Uh, it does happen where uh, some mistakes are made on your credit history, and it's better to know that up front so you can address them versus when you're about to write an offer and now you realize that you won't be able to buy that house that you just fell in love with because now you have to deal with this mistakes on your credit history. So you have every reason to start the pre-approval process. I actually recommend doing that 6 months in advance, so you have the peace of mind that you're good to go the moment you come across a property that matches your criteria. One thing that I wasn't planning on talking on, but I think it's also important, is the breakdown of your monthly payment. We were using the term PI, TI.
Mhm.
Some people might not know what that stands for. So PITI stands for principal, interest, taxes, and insurance. The one additional cost that is not included in the acronym is um, MI, mortgage insurance,
Correct. Yeah.
if you're putting less than 20% down. And I keep hearing this, especially from older generations advising the younger ones. And they're well intended. I'm well intentioned, but I keep hearing here. My dad says not to ever buy a house with less than 20% down because mortgage insurance is gonna kill me. And I'll give you a specific example to illustrate this without disclosing identity. Someone bought a house for 475,000. 20% of that is close to $90,000. Mortgage insurance on that loan was about 163. So if you follow that advice from dad or grandpa, it would have taken you $90,000 to save $160 on your monthly payment. I will argue that this is better use for such large amount than simply to save less than $200 a month. So there's a lot of misconceptions out there when it comes to mortgage insurance. Yeah, ideally you don't want to have it, but we'll also want to talk to you about wealth building uh, uh, options. So the opportunity cost to use almost $100,000 as a down payment to save a couple of $100 a month is just too great. Um, so talk to your lender and look into different options because mortgage insurance is not a killer. Sometimes you will be better off taking that additional $160 a month and then using the rest to invest somewhere else and double your money somewhere else. What are your thoughts on that?
I totally agree. Mortgage insurance to me is actually a really, really useful tool because, I mean, just using your example, how many people do you know that have $90,000 lying around or have access to family that can provide them with that money? It's not a lot of people. So the fact that you could put 3.5% down on FHA or 5% down on conventional or 3% down on conventional if you're a first time home buyer, that's actually a gift. And mortgage insurance is what allows the government and lending companies to protect themselves to do so. So if you have good credit, you know, in the 700s, oftentimes maybe above 740, mortgage insurance at 5 or 10% down can typically be less than $200 a month, oftentimes. In some cases, less than $100 a month. And if the intent for most folks right now is to watch the market and refinance in the next 24 to 36 months, you're going to be paying that less than $200 a month or less than $100 a month for 24 months. So let's just use an easy number, $100 a month on mortgage insurance, and you refinance 3 years from now. You've spent $3,600 in total on MI. I don't think it's worth spending 45 grand to get your down payment to 20% to avoid spending 3,600 in total. In fact, I think that 3,600 is an excellent tool and would allow you to use that extra down payment, like Alejandro said, somewhere else. I would think that you could take 45 grand if you're going to put 10% down and make $3,600 over the course of 3 years somewhere
Yeah, without much trouble.
easily.
Yeah.
Yeah, yeah.
Yeah.
So, I mean, it's MI can actually be a really helpful tool because it allows you to keep more cash on hand and use that cash for other things. So absolutely, it's got a bad rap, but I don't think it's I think it can be more helpful than anything else.
Yeah. And just to clarify, I'm not saying that for everyone the cost of MI is $200 or less. Again, that's going to vary, like Greg said earlier in the conversation, on your credit score and other factors. What I'm saying is that it is worth having the conversation as to
Yes.
whether or not having putting 20% down makes sense to you uh, individually, specifically.
Yep.
All right. So hopefully this helps. So to recap, start the pre-approval process early. That should be your first step once you make the decision to buy a house, especially if you're selling one. If you're a seller who is, say, upsizing, have a growing family, before you list your house for sale, you need to make sure that you qualify for the house you're trying to purchase before you sign any paperwork.
Mm-hmm.
So start the process early, ideally 6 months in advance. And uh, when it comes to documents required, make sure that you have your pay stubs ready, you have your W-2s ready, self-employed, have your tax returns ready, profit and loss statement ready, and uh, and then manage your debt because that's probably the single greatest factor that will affect your loan amount and loan terms. So do not go and take on $1,000 car loan right now if you're thinking about buying a house. And I've seen that happen too. So,
Totally.
um, so don't do that. After you buy a house, you can do whatever you want.
Great.
So
Yeah.
just be more calculated and intentional
Yeah.
before we hand you the keys to your new place. Right, guys. Hopefully this was helpful. Have a great weekend, and we will see you again next week.
See you later.